I'm happy to be here with you. I'm glad that you came, and I'm glad that Delia was working with me. She gave a great intro into why it's so important to start right away. And those of you that haven't, whatever your history has been, discard it and just start from now. So we're saying any choices that you've made in the past, now's the time to fix them and just try to start to move forward. So let me share my screen with you. So now you've created your emergency fund so that you're not paying Visa and MasterCard, any of your hard-earned money. You have saved up a certain amount of money and you're ready to start investing. And for a lot of people, this is a really confusing time. There's so many things that maybe you're not used to hearing, and it just seems overwhelming. So we're going to get it all cleared up for you. You should be able to have a basic understanding once we're done. Please ask any questions. Delia will monitor the chat. And so we're going to talk about some of these things to help you on your way. So you see all of these different things. Well, we can kind of to categorize those. So we have 3 different things to think about. What kind of account you're going to be investing in? What type of things are you going to buy to put in there? So what kind of investments you have, and other ways that you can get your money invested in a little bit easier way. So here we go. The types of accounts. So we have here, you have accounts that you set up through your workplace. There's also individuals some that you set up on your own, and some accounts that are taxable. So let's kind of go over those a little bit and we'll see what happens here. So we have here in your workplace, you've probably heard of 401k or 403b, depending on who your employer is. They also, and somebody brought this up earlier about what a Roth is, and we'll kind of go over that a little bit and explain how that works. But this is a Roth 401k, so it's not exactly the same as a Roth IRA, but these are offered through your work. 457 is usually for, depending on the type of employer that you have. And just recently, as of last year, California instituted a new plan called Cal Savers IRA. Now, these are offered by the employers. They set it up through the payroll system, but they are regular IRAs. They just is a way for you to get started, and the employers are not in charge of anything. They are in charge of getting the money into your account. That's the only thing. But as far as investing, that's your decision. It's yours. If you go to work for somebody else, it's yours. Well, they all are, but this one has no kind of vesting, meaning you only get part of it if you leave. So everything you put in there is yours to take with you at all times. So the next thing is the IRAs. So these are, in fact, that's what they mean, individual retirement account. And there are 3 different types. One is the traditional. You just say, okay, I'm going to start saving for my retirement. And you go to a bank or a brokerage house or a credit union, and even online, there's a lot of ways you can set up, and you say, put in your information, and usually you set up at the same time some kind of automatic transfer so that you're not, so it's easier to accept this kind of deduction in your out of your pocketbook. And the SEP and the Simple, those are accounts that are, they are individual retirement accounts, but they are set up through the workplace. So I should probably have that in a different place. And the Roth. So let me explain the difference between a regular traditional IRA and a Roth. So as you know, the reason that the retirement accounts were originally set up were to give you a tax advantaged way to save for retirement, meaning that you get paid $1,000 and they take whatever you decide. We'll just say 1%. So you get paid $1,000. So $10 out of every paycheck is going to be put into this account. When they go to take the taxes out of your paycheck, they use it on that lower number, the $990. That $100 or the $10 that you have put away doesn't get taxed until you retire and start taking money out of your account. And it is counted as ordinary income, so payroll amounts of income. But theoretically, and the idea is that right now you put that money away and it's growing and it's growing. And when you retire, you're in a lower tax bracket, so you have to pay less tax on it. And then you have the money there available for when you need it. A Roth is just the opposite. It is a retirement account, but it's after tax money. So you have your paycheck, it's $1,000. They deduct your payroll taxes, you get your paycheck, and then the money or the amount, and then you send the $10 over. So your disposable income at the time is lower, and you can't write it off on your tax return, which you can with the regular IRA. Now in 2021, you can contribute $6,000 to an IRA, whether it's through CalSavers or through your own or through the Roth. They are all the same amount, $6,000. There is a catch up if you're over 50. You can also increase that by $1,000. The 401k amounts are much higher. They are $19,500 with a $6,500 catch up for those over 50. Now, but those have to be set up through your workplace. If you don't have that there, then you are not able to take advantage of those higher numbers. And certainly if you have any questions, just type them in the chat, and Delia will help me to answer those. Okay, next one. Taxable. So say you've maxed out, the only thing you can put in is $6,000. That doesn't mean you can't save more for retirement. It just means you can't save it in this tax advantaged way. A taxable account is you put another $1,000 in. It can be anywhere. It could be, and we're going to talk about the types of investments that you can do in a minute. But they can be a savings account, a brokerage account, any of these things. Now, as you invest, you get dividends or you get interest, and those amounts are currently taxable in the year that you accrue them. So that's kind of something to think about. The type of investment that you put in each of these different categories may be slightly different because of tax considerations. That's a little bit beyond what we're going to go through today, but something that as you pursue this, just kind of a heads up to pay attention to that. Okay, so now we are going to move on, and here is a poll question, which is not a good reason. So three of these are going to be good reasons, but one of them is not a good reason. So lowering your income, it grows tax deferred, the employer might match it if it's a 401k, and I'll eventually have to pay taxes, so why do it? So Delia, you want to put that poll up for me? Oh, there we go. Okay, so go ahead and give us your thoughts.
This is savings and investment, excuse me. Let me do poll number 3. I was answering a chat. Let me launch the poll.
I know this is a little bit more confusing because if you're not familiar with these things, but this is a way for us to share and make sure that you're clear on what we're talking about here. Okay, let's go ahead and just close this out. Let's see what the answers are. All right, so number 1, it lowers my taxable income. that is true for IRAs, but not a reason would be if you have a Roth. So Roths do not lower your taxable income. So that one's a little bit confusing, but in general, it does. If you have a regular 401k or a regular IRA, it does lower your taxable income, which means you have more money right now, which is usually a good thing. You'll eventually pay taxes. Okay, that is not a good reason not to do it. So yes, you're going to pay taxes, but we want it to be growing, to save it so it's there when you need it. Otherwise, as when we saw the chart of putting it away when you're 40 years from retirement, 30 years and 20 years, and the huge increase, and even 10 years, it gets almost undoable. So starting early is better. And so saving it now is a great reason to participate. Okay, so let's shut that down and move on to our next topic. So we want you to all participate if you can. So those are the types of account, or the types of accounts. Now we're going to go into types of investments. So we have this little guy here. He's trying to figure out what to do. And you can see there's a number of things that he could invest in. So here we go. We've got individual stocks, individual bonds, and a professionally managed basket. And we're going to kind of go over those one-on-one. Like I said, please ask questions. We want you to be able to, we want to be able to share the things that we know with you. So mutual funds are managed and exchange traded funds. And we'll get into those as we move along here. So each one has its own risk, and each one has a different type of return. So stocks are equities. They are ownership in the company. And I'm sure you hear the stock market trading up and down and up and down. It gets reported a lot in the news. And so you are able to buy a share of a company, and you own them through a brokerage firm. If it is, or in your retirement, they'll use their own brokerage firm, but they do have to be traded in the stock market. We own them because that's how we want our money to make money for us. So we buy companies that we think are going to either grow and get bigger, or that are going to pay us in the form of dividends income. There are risks. If you have paid attention to the news, there are huge risks, and the market is getting more volatile all the time. But in the long run, the stock market has been very consistent in the returns. And as long as you don't have to sell at a bad time, and historically, you've always made money. Over the stock market has always gone up. All right, so the next one, the other options are bonds, and we call them fixed income because normally when you have a bond, the terms are fixed. So you know exactly how much money you'll get from that. So say you buy a bond for $1,000 and they say, we're going to pay you $50 every quarter. So you know exactly how much you're going to get back. A stock, you have no idea what the value of that share is going to be in a year. You have no idea how much they're going to pay you because they determine that on an ongoing basis, usually quarterly. Now, the reason that these are fixed is because you know what you're getting, but also these are a loan to a government or to a company, and they say, and so you have more tangible guarantee on this. And if the companies were to go bankrupt, the people that own a bond on the company are going to get paid first before people that have money in the stock market, in stocks. And I have know that personally because I had investment in General Motors at the time that they declared bankruptcy. And I wished I'd had a bond with them rather than owning the stock, because we just got pennies, for the ones that we owned. Eventually, some of them I just wrote off because I was never going to get my money back out of them. So these are more guaranteed, they're safer. So I'm going to show you this return risk trade-off. So you see on the left-hand column, it is the return. So the return is the money that you're going to make or the growth of your stock. And along the horizontal is risk or volatility. Now, normally this is how it works. You have here lower risk means you get a lower return. So that would be the bond category. They're safer, so you don't have to pay as much. So they don't have to pay you as much for lending them the money. The opposite is higher risk as the stock market. It could go sky high, as you've seen in some of the Bitcoin, but you've also seen in Bitcoin that it's dropped tremendously. So those are extremely volatile. But normally, historically, a stock gives you a higher return, but it's also riskier. So those are the two components to think about when you are looking at investing and relying on the type of investor you are. So there are people who don't even want to do anything with their money, and they hide it under their mattress. And as Delia explained, you are not even keeping up with inflation. So that's probably not the best idea to put your money under your mattress. But if you are the type that really worries, then go with a lower risk. If you are younger, you have more opportunities for overcoming any dips or any crashes. So you have the risk ability to take on more risks. All right, so, and it's all personal. Now, mutual funds can be a combination of all of these, any of stocks, bonds, and other types of investments. And it's a company that puts these together. So they go out and they buy some Apple and some Costco, and they buy Chevron gas, and they put it all together. And you could say, okay, I want a diversified portfolio with a whole bunch of different stocks in it, so that if one of those companies does very poorly or even goes bankrupt, you have all of these partial tiny shares of multiple companies. And some of the mutual funds are huge. They have maybe 60, and yet there are some others that are small, or they're specialized, or they only focus on healthcare, or they only focus on tech. So they have a huge variety. In fact, there are more mutual funds companies or mutual funds than there are actual companies listed on the stock market. So you can go on any type of sector, any type of focus, any like international, or you can get a balanced where they go in and they do some of these for you. And I'm going to show you that in just on the next slide. Exchange traded funds are mutual funds that are traded on the stock market. So they go in and they buy a certain amount of mutual funds or invest in mutual funds. And then you have the opportunity to go like a stock and say, I want to buy this. So you can track it during the middle of the day. Mutual funds, if you go in to buy it, you'll say, I want to buy $100 worth of this mutual fund. And at the end of the day, they'll tell you how much, how many shares you got. Or the other way would be, I want to buy 100 shares of this mutual fund. And at the end of the day, they're going to say, this is how much it's going to cost you. So mutual funds, you can't price. The ETFs, you can track it. And sometimes there are some advantages to that. But those, yeah, so there's advantages and disadvantages to them, but they are both the same thing, just different ways of trading them. So here's an asset allocation chart. So if you decide that you are really, really worried about the stock market, you might go down here where it's risk averse and say, okay, I'm really worried. So I want to say safer, which would be the light blue. The bonds are safer. And so I'm going to have part of them in there, but I want to have a little bit of growth in there because I need to keep up with inflation and better it. So you're trying to always have growth in your account. Now, if you are really aggressive and you like to go to Las Vegas, I'm just joking, but the people that find it exciting and they're trying to find the best thing, you might go in the highly aggressive. So part of these are personal preference. Part of it is time. So as you can see underneath each of these circles, the pie charts, they are recommended that you get more conservative as you get closer to retirement. Because if 2008, 2009 came again, and you were retiring that year, it would affect the entire rest of your retirement period if you have to start taking money out when it's at this low. Okay, let's go on. And so the other offset too is timing the market is extremely risky. So just kind of FYI for you, if you miss out on the best day, so the stock market doesn't grow, 1% every day. It grows, it shoots up and then comes down a little bit and then shoots up a little bit. So as you can see on the next chart, it very, very wobbly goes up. But you don't know when that one day is going to be. You don't know when the market's going to drop. So to time the market is extremely risky. A lot of people at the bottom of the market, 2008, 2009 said, I can't take it anymore. I'm taking my money out. And I'm going to show you what happened to that. So if you stayed in the whole time, you put in $10,000 back in 1980, look how much money you'd have here at $659,000. If you miss just the 5 best days, it drops by 35%. So there were 50, they chose 50 good days. So that is not very much over this time period, right? So you're talking almost 40 years. If you missed 50 days, then that's like 1 a year. You would have only, your returns would be down 91%. So it's best to keep putting money in, on an ongoing basis, on a monthly basis, and get your money working for you that way as much as you can. So here we go, stay in the course. So if you had got out of the market, so this is exactly what I'm talking about, 2008, 2009, if you took your money out at the bottom, you see this bottom line here? You did not grow at all. I mean, it just went up by a infinitesimal fraction, okay? If you went out of the market at the bottom and said, okay, things are getting better, I'm going back in, well, you got 195,000. So you took advantage of most of this growth here. If you had just stayed in there, just said, okay, I won't even look at it, I'm just gonna leave it in there, you had almost $300,000 just by leaving it there. So stay the course. Don't overreact. Don't make emotional decisions when you're being fearful. And the opposite is true. Don't make decisions when you're feeling like, oh, the stock market is going so high. I better get on now, and I better get some money out of my accounts, my emergency fund, and throw it in here, kind of like Delia had before, where it said, you got the best next sure thing. Be careful when your emotions are involved in the decisions that you're making. And that goes for not just investing. All right, we have a poll here. And so let's decide which one of these are. What are components of a successful saving and investing plan? So start early, regular investment. So we're talking about on an ongoing basis is great. Be a long-term investor and don't try to time the market. Most people that go in and do the day trading end up losing money, or the answer is all above. So here we go. We've got the poll. Go ahead and answer. Okay, I can tell that all of these people are paying attention. So good. Okay, I think we have most people on here. Delia, do you want to show us what the results say? All right. So start early, absolutely. Make regular investments, absolutely. Be a long-term investor, absolutely. So that takes us to all of the above. So each one of those are great things. If you can do it, perfect. Okay, so let's close that down. Okay, so now these are ways to improve your financial literacy. Subscribe to a personal finance publication. You can get them on your app. You can listen to podcasts, any of these things. Just one hint about this. So if you get a magazine, say Money Magazine, and it tells you, here are the things that you should invest in, just think about when the editor said, okay, let's do an article on this, how long ago it was that they wrote the article, how long ago it was that they put it in there and printed it, and how long it was to send it to you. So these kind of personal finance things are generally not current. So use your own judgment anytime you're making an investment decision. Follow a financial planning professional. That is a great idea because it gives you tips, it gives you reminders, and also motivates you to move forward and to try to give you confidence in making the decisions. A personal finance course, there are high school and colleges. There's also many that are online. Just check out, make sure that it's somebody that you trust that's making these is teaching these for you. Check your bank and your credit union. There's a lot of information. The government also has a lot of information. Look around, and people want, the government especially, they want to make sure that you make wise decisions and don't get taken advantage of. And here we've got 3 books that were recommended. The Millionaire Next Door, which you may have heard about, The Little Book of Common Sense Investing, and the index card. So take a note of those and further your financial education. And even though Delia and I are both certified financial planners, we have requirements to do continuing education, and we are constantly studying and constantly trying to keep up because there's so many new things out there and there's so many things that can be learned. So even though she and I have been in this business for many years, we still are learning new things, and still, as things change and the government changes the tax rules, and as we have different options, and so continually improving is a great idea. So here we go. We do have a website where you can go for information. They are having a little bit of a glitch, though. The website that you went to register isn't currently working. So this will work. I think the other one will work eventually. But right now, we've got Financial Planning Association.org/FPA, so Financial Planning Association of Orange County -community-outreach. Sorry, it's really long. It'll probably be fixed by next week, so you might have a shorter one. But certainly get in touch with us if you would like to have your own one-on-one personal financial planning session. And this is a time for you to talk about what should I do. Because everybody is in a different situation, you're different ages, different income, different risk tolerance, different assets and challenges. So, and all of the CFPs that are on there are very well qualified to give you some advice and help point you in the right direction. Now I'm going to open it up for questions if anybody has anything that they would like to bring up.